Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. This is Richard Benuli. Today we have Ira Harris, Peter Boockvar, and a first-time guest, Chris Whalen. Ira is an independent trader, successful hedge fund manager, global macro consultant, trading foreign currencies, bonds, commodities, and equities for over 40 years. He was also CME director from 1997 to 2003. And Peter is the chief investment officer of the Bleakley Financial Group and of Bleakley Advisory. He has a newsletter product called the Book Report, spelled B-O-O-C-K report, all one word, .com. It offers great macroeconomic insight and perspective with lots of updates on economic indicators. And Chris Whalen is an investment banker, author, and chairman of Whalen Global Advisors, LLC, which focuses on the financial services, mortgage finance, and technology sectors. He was a co-founder and principal of Institutional Risk Analytics from 2003 to 2013. He has held positions in organizations such as the House Republican Conference Committee, the Federal Reserve.
God, you're talking about that? That's okay.
Okay.
No, the key thing, most recently I ran and built up the financial institutions group at Kroll Bond Ratings, which was a lot of fun. Kroll's really a ABS house, first and foremost, commercial real estate, resi, all the rest of it. So it was it's still a very small firm, competing with giants, but it was a lot of fun.
Great. And also on the board of directors for the Global Interdependence Center, GIC, in Philadelphia.
David Kotok's little project.
Yeah.
It's fun to mix business with pleasure. Fishing. Central bankers go fishing.
Yeah.
Activity.
I'm actually going next month to the GIC conference in Buenos Aires, and then fishing before that.
Okay.
There's also fishing after sort of Camp Kotok in Argentina.
Yes. Well, some of them go to Maine. Ramiro Lopez Leroy, for example, will take one of his kids and just show up in Maine, which is about 15 hours by plane. So, it's a lot of fun. But they're great people, very diverse group with GIC. We're going to Germany this year to the Bundesbank. So if you like monetary policy, that would be a very good trip to go on. I would recommend that. So what do you want to talk about this morning?
Yeah, Bundesbank has disappointed me the last few years, how they gave Draghi license to do what he's done.
Well, they kind of had no choice. I find it amusing that Northern Europe's cranking. My relatives in Holland, for example, are having a great year, and yet Southern Europe is not. And that dichotomy, I think, is ultimately going to be very difficult for them to deal with. Because, the Germans, they look at Southern Europe and they just see, more checks to be written. And the politics of that has slowly undermined Merkel. So it's very interesting to watch. And then Berlusconi coming back in Italy. Isn't that great?
Yeah.
I always tell people, read about Berlusconi and you'll see where America's headed.
Yeah.
The happiest man. He'll be making trips to Italy.
Yeah.
Yeah. Well, Draghi's been trying to keep Europe on ice by, pushing debt costs down to zero, but the debt keeps growing. So, what are we really about here? There's no fiscal discipline anywhere in the Western world, and the Chinese don't care. It doesn't matter in China. It's a political issue.
Yeah.
That's why I was writing about H&A recently, because ultimately, whether that company survives or not will be determined by Uncle Z. That's how it works in China. There's no church and state. There's just the state.
He may want to set an example, though. H&A could be a good study.
Well, they were a little ostentatious, a little sloppy with the parties, pasting their name on the side of office buildings all over the world. I think we have 3 of them in New York.
Okay.
Quite fascinating. Yeah.
So a few weeks ago, Chris, you wrote an article, Bank Earnings and Volatility. Maybe we can begin with some thoughts there. How have the Federal Reserve and other central banks, how have their actions affected the credit markets, the financial markets in general, and the economy in general?
Well, what the central banks have done is they've removed a lot of assets from the market. They've gone out with a variety of new money, and in the U.S. case, excess bank reserves, and they bought treasury bonds, and they bought also mortgage bonds, the recent vintage Fannie Mae, Freddie Mac, Ginnie Mae paper, which have 3 and 3 1/4, 3 1/2 coupons, right? So late vintage stuff with very low prepayment rates. Those bonds are going to be around for a long time. And in fact, one thing I remind people of is about 40% of the market today is the FHA and Ginnie Mae, and those loans are assumable. So they will stay with the house, and the house will trade, and the loan will be conveyed to the new buyer. It's going to become very interesting over time to see how that affects the portfolio. But essentially, the central banks have taken all this duration out of the market, and since they're end investors, they're basically buying the paper on credit, and they don't hedge it. So the capital markets activity that you used to see around a lot of these positions when they were held by trading firms and banks and others who were going to trade the assets, right, and cared about mark to market every quarter, is greatly diminished. There's no hedging. You know, the Fed's not out hedging its book, and this is a problem now because the Fed is now illiquid. They can't sell without creating a loss, and they dare not do that because it gets them in trouble with the Republicans in the House who don't understand monetary policy at all, but have a lot of opinions on it. And so you have this weird situation where the Fed essentially has their hands tied. They're going to wait for the book to run off, which they hope is about $20 billion a month. And I think they could be wrong. I think they could be too wishful in terms of the runoff rate on some of that mortgage paper. Those Fannie Mae 3s are going to be around forever. The prepayment rates are going to be very low, especially if rates continue to move up. So that's kind of what I see. The trading line on Wall Street in earnings greatly diminished by this. Then you have the Volcker rule. So all of the books, the investment books that the banks used to trade every day just to value the assets are passive now. So you put those two data points together and you understand why Goldman Sachs, why all of the banks have seen an enormous reduction in their trading volumes. And then the other issue too is the mortgage market's down. So there's less hedging. That forward market for mortgages, what's called the TBA market, a lot less activity. We'll do $1.5 trillion new mortgages this year, which is down. The peak was 4.5 during the 2000s. We don't want to do that.
Chris, why aren't we seeing any C&I loan growth?
The banks had to slow down. They had a pretty good run in 15 and 16. We had a little scare from oil, which didn't really materialize. Most U.S. banks did fine on oil credits. There were some restructurings, but the banks we followed, like Cadence, which is a small lender that was purpose-built to do energy, they had no problems. But now a lot of banks have run up against a regulatory limit on commercial real estate loans, multifamily. There's a big shtick now for the smaller banks. And so, they've essentially run out of customers in certain markets too. But the OCC, for example, is forcing regionals to pare back their multifamily exposure because the prices have gone up so much. They just look at that and go, whoa, wait a minute. And they're right. Loss rates on these assets, multifamily assets in major urban areas, are negative. So if the loan defaults, you're going to sell a loan for a lot more than the property for a lot more than the loan. And that's reflected in the ABS numbers too. So it's an interesting time, in terms of different asset classes, but I don't see a lot of growth in the book. I really don't. BA had a good quarter, for example, at year end, but that was the exception. Most of the rest of the big guys were not growing. And then, PNC had a very good quarter and had a nice tax number. But, I think overall, don't look for alpha in the banking industry between the regulatory changes and just the tenor of the economy. I mean, you would be in the bond market, right? Anybody could raise money in the bond market in 16 and part of 17. So, we had a bull market in fixed income, which has driven a lot of strategies. So, I'm sure Ira has some thoughts on that.
But let me let me ask a question with regards to that. Chris, I was really taken with it because it's such a good point. Because, yeah, it's between the ECB and, of course, the BOJ, but certainly the Fed. And your piece about the dynamic hedgers missing from the market, but that they are going to resurrect themselves here as more paper winds up in the hands of private holders, be it pension funds or whoever, insurance companies. But do you think that Jerome Powell, when I go back and read some of his earlier stuff and, of course, his initial foray as a Fed governor, he was opposed to this, or he had a lot of issues with the massive buildup of the balance sheet. Do you think he might make the mistake and be quicker? I'm not sure it's a mistake, but he might be quicker to say, hey, we can hold the Fed, let's say, at 2%. Maybe we should ramp up the selling off of some of the assets. Do you think that's a possibility?
Well, I think the snippets from the minutes that have suddenly found people's attention, which is very funny, right? We only pay attention to chairman. It's a cult of personality. So here you had Powell saying some very interesting things, very forthright, not an economist. He's a financial guy, and I'm told fairly decisive, although he's quiet and he listens, right? But he's worked on deals. He knows how to make decisions. On this, he's got politics because the Congress, you remember years ago, they confiscated the Fed surplus to pay for a highway bill. And the idiots in Congress, I wrote about this for the American Conservative, treat remittances from the Fed as revenue. They don't understand that it's an expense foregone. It's not revenue. It's just you're making the debt go away. So every year, they look at this money coming in the CBO and everybody else at Treasury, they all say, oh, look, it's revenue. But it's a snake eating its tail because the Fed and the Treasury are one. It's like a Hindu god, right? But in economic terms, they're the same. And Bob Eisenbeiss, who I interviewed, by the way, is wonderful on this issue. He's very funny. So, I think that Powell is going to be a lot more straight talking than the others have been. And I fault Yellen and Bernanke on this because they should have gone out and said to the Congress, no, you can't behave like this. This is ridiculous. You don't go confiscating our surplus. It was just part of Washington politics, but the Fed didn't respond. If Paul Volcker had been there, he would have been up on the Hill kicking the shit out of them. And the problem is these are bureaucrats. They come from academia. They have no money. And so they don't know how to behave in big league politics. It's a tragedy. I think Powell will be much better. I'm very hopeful about his tenure as chairman. I desperately needed change. We got to get the economists out of the temple. I'm sorry. I love them, but they can't make financial decisions. No. You want them on the staff, Ira. You don't want them trading.
We wish that was the case 10 years ago. Now Powell gets to clean up the mess.
Exactly. And, look, Volcker and Corrigan cleaned up a lot of messes, too. They always were cleaning up other people's messes. This is
the biggest mess the world has ever seen.
Oh, yeah. No question.
Yeah, and of course, because going back, this is a cult of personality. You wouldn't know that the best really paid attention to the media. Great, these are the greatest people. The Mets. And Bernanke, his book was misnamed. It should have been The Courage Not to Act. I think he missed the.
Right. Bailing out people doesn't take courage. It's not bailing them out is what is courageous.
Well, precisely.
Right.
And the Fed has not said no in a long time. They haven't said no to accommodating Treasury auctions, and they haven't said no most recently with this lunacy of QE. I mean, the first one was fine. It had to reliquify the banking system, as Walker Todd pointed out to me a while back. But the rest of it was crazy. And then selling all the short-dated stuff and loading up the book with long-dated treasuries. So they own mortgage backs with an average life of like 12 years now. They've extended a lot, by the way, over the last 18 months. And even if the portfolio gets smaller, the duration's going to go up. How about that?
Chris, what was their thinking in their models with Operation Twist to say, okay, in their models, let's flatten the yield curve, and that will be good for growth. And then today they express worries over the flattening yield curve.
Well, I know, but this is the point. You see, when you have central banks take all this duration out of the market, nobody's hedging the position. Well, obviously, it's going to be hard to get those maturities to back up because there's nobody selling Eurodollars, there's nobody doing swaps or anything. There's nothing. So, the market's in stasis, really, and they're going to push up the short end, but there's nobody pushing up the long end. So it's gone up a bit, but I keep wondering. I wrote about it this week. I'm a little, hedged on my bull market 10-year trade, right? But there's still nobody out there selling it. So I do think you have a flat curve in prospect. I agree with you. It's it's bond market basics. It's got to be somebody at that table in Washington who understands the bond market. I think Powell does. There's hope.
Yeah. But in understanding that bond market, Chris, do you think that he would move to try to steepen the curve by maybe offloading, by holding the front end, and going, hey, we don't have to raise rates. If I get to 1.75 on the Fed funds rate or 2% on the Fed funds rate, I'm basically at a neutral real yield. That's where I am. Which is not historic. That's probably, and I'm not using their terms of neutral, but that's probably about neutral on the front end. Maybe the real yield on the front end goes to 50 basis points positive, but I don't think he goes there. So would it not be in his possibly mindset to say, hey, let's start shrinking the, as Peter would say, quantitative tightening on the longer run on duration, and if the yield curve steepens out to 120, 150 basis points, it's not necessarily a bad thing.
No, I totally agree with you. And if the Fed were acting rationally, they would be doing all of that. They would have even been hedging a bit of the book. Just trade it. Go out and hedge some of the duration.
Afraid of damaging or of infecting its bubbling asset prices.
Well, that's part of it. True.
That's behind their entire thinking.
But bureaucratically, in Washington terms, they don't want to take a loss because then the remittance to Treasury goes away. And believe it or not, in the small-minded world of some of these Fed people, that's what they worry about. So factor that into your thinking too, because he's absolutely right. They should be trading the book. They should have been doing a lot of things, but they're not thinking like market people. They're thinking like Keynesian and academic economists, and it's scary. It really is.
In your article, you mentioned also that this is going to result likely in a volatility returning to the markets, that we're all short volatility. Can you elaborate on that? Yeah.
Well, that was the comment from Powell. He said at the end of that little snippet from 2012 that Zero Hedge posted that they were going to unwind their short volatility position, and in classical terms, if you buy a portfolio of RMBS, it should give you a relatively short position vis-a-vis the market, right? But in this case, though, I think the other part of it is, from our perspective, the market, right? We're sitting here, he's got all the duration, and we're buying. Now all of a sudden they've said, well, we're not going to buy anymore, and we're going to let it run off. So eventually, private market participants are going to take up that duration. Think of it as the weight that they have to support with capital, and they'll have to hedge. So you'll see market activity return. I think the Fed has missed an opportunity to get a little bit more of this done more quickly and figure out how much the street's willing to support, because that's the thing we don't know. The Fed's been supporting everything.
Well, the Fed lost their opportunity. The Fed had a chance to raise 3 times in 2015, three times in 2016. Yep. Now they're entering a situation where maybe the Fed funds rate tops out at 2.25, and they have now an issue with this falling dollar and bubbling inflation pressures. And just imagine when we do hit a wall and they start to cut rates and what the dollar is going to do under that scenario.
But you know what? I think it's a lot simpler than you put forward, which is go ahead and keep your little march, your quarter-point march, right? If you see spreads start to widen, you stop. It's the basic Irving Fisher test, right? And that was the playbook when Bernanke was dealing with the crisis.
Too much of a free lunch for me. I think that there is no free lunch in reversing this policy that they've implemented. And
so what, you think we go to 6%?
No,
that's what Yellen said years ago.
We don't need to go to 6% to cause a major problem. All the 10-year needs to do is go to 3.5, 4, and you got, I believe, a recession on your hands. I think the sensitivity to changes in interest rates is dramatic as it's been. You have duration levels that are as high as they've ever been globally. Yep. That's where the risk is.
Well, you'll certainly see defaults go up because we're hiding a lot of defaults with the artificial
and it's not
manipulation.
Just us. All you need is
everybody.
Zero interest rate. All you need is zero interest rates to go back to zero, and $9 trillion of paper is going to lose a lot of money mark to market.
Hey, I know. That's why they Draghi is not
I should
changing.
fix that. It's more than mark to market. It's real life losses.
Yeah.
Well, and then you throw in what is, from a trader's point of view, which is piled on here, is the risk parity guy. No wonder, Ray Dalio, who never used, you have to stick a feather under his nose to get him to say something, is awfully chirpy of late. And I'm wondering whether he uses these times to try. I mean, that position is enormous that they're carrying, and more people have synthetically recreated that. He's got to realize that all this volatility selling is all from people who are mimicking that risk parity trade. And you can mimic it whatever way, you can recreate this trade synthetically in a million different ways. So when you actually have to start unwinding this, almost like a long-term capital in 1998, you're not going to be able to get out that door because there's a lot of people who are going to be squeezing out that door at the exact same time that you want to go because they have the same position on whether you realize it or not.
Well, of course, and the VIX is just a popularity contest. There's no basis for that contract. It's just a matter of supply and demand. It's like CDS. There's no basis in the underlying credit anymore.
Yeah, but there's the VIX is still being determined by a lot of participants placing their bets and on puts and calls.
Absolutely. But a lot of them weren't hedging the past few years. So everybody was leaning in one direction.
Of course, yeah, and that's why it's falling.
Absolutely. So but I think you would see default rates double in Peter's scenario easily. And I think that's the latency in the system. If we see the 10-year get up to like 3%, I think the windows will be shaken.
And I read a stat over the weekend that that 40 of the Russell 2000 companies, 40% of the debt is floating rate, and that cost goes up every single day with what LIBOR is doing. I mean, even the 2-year note yield today is up to 2.12 every day.
Well, that's what I've been wondering about. Is imagine the reissuance of equity that was bought in by these guys as they desperately try and pay off this debt. That could be a lot of fun.
The 1-year bill today is now where the dividend yield in the S&P 500 is.
Because we've had 4 years of amazing bond market activity, record activity each year in terms of new issuance. And I would say, half of it was to fund stock repurchases. So it's been quite something.
And you know what? And there's another part, picking up on, Chris, on your piece with the bond, when there's been a lot of, Peter, before you came on, Chris was making me laugh when he was talking about when he was involved with the Fed back in the 80s. But there's also, when like the BOJ and the ECB are busy buying corporate assets, there's no hedging that goes on there either. So, and there's also no stock relending. And another issue, which I raised. Yeah,
that's true. They may not lend the assets. That's right.
They don't.
The Asian central banks are very, very conservative on that stuff. They won't repo.
There's no rehypothecation of anything. So now all of a sudden the game gets even more interesting. And the question becomes, can all these ETFs, do they rehypothecate? Or does that result then in everything that's in that basket of ETFs being basically waylaid off the market and make it even more expensive for short sellers? So we're not getting any short selling for some of the companies that are involved in these ETFs, which are really miserable companies. So the whole dynamic here has shifted, and I'm not I don't know that the players have really shifted.
I don't know about the ETFs. I would suspect those assets are available. But the central banks are the big thing. When they buy all of this paper and just put it away, you're right. It doesn't come out. It doesn't get loaned. And it reduces liquidity. That's, to me, the key thing. But, the fascinating part is, look at the Swiss. Swiss National Bank is out buying stocks. Why? Because if they don't, the currency will appreciate. That's their chronic problem. They just can't keep the money out. And even with penalty rates, they still can't manage it. So if they stop doing it would go up.
That's one of the interesting central bank comments this week was from the deputy governor of the Riksbank in Sweden, who's also gone down that rat hole of negative interest rates. And she said that they're not going to wait for the ECB to start raising rates. They're going to probably start doing it this year. So I think that there is an end in sight to this negative interest rate experiment over the next 2 years.
Well, look, the whole system's got way too much debt and a lot of debt that's mispriced. So like I say, you'll see the banks start to lean into this too. I think you'll see provisions gently go up from where they are. I was surprised to see the credit cards up this much this quarter. But mortgages are still real quiet, and commercial is very quiet because, like I say, the collateral values have gone up so much. A loan you made 2 and 3 years ago, the building will get sold easily for the principal on the loan, which is typically a 50 LTV loan, right? So look at the equity that's been created in commercial, multifamily and large commercial real estate over the past 4 or 5 years. It's ridiculous. And it was all levered up again. Look at New York.
3-4%.
Yeah, New York's going to be a lot of fun. We have compression underway right now.
Will the cheaper dollar bring back foreign buyers to the U.S. market to hold this market up for a little bit longer than otherwise would have been?
I don't know. I've been trying to get some good data on that because it depends on a lot of things. And there was certainly a gold rush for a while, but then the Chinese shut the door. They changed the rules rather significantly. Yeah. That's what H&A is about. Same thing. And I think Europeans too, things have calmed down a bit. So you don't have that crazy flight capital that we saw in New York, in 2015, 2016. But the bid for high-end condos, that foreign bid is definitely waned. I know a couple of brokers who just do that market. And, there's a lot of stuff for sale.
There's a lot of signs that commercial real estate has peaked out in this cycle.
Oh, yeah. Yeah, definitely. But, some markets are still completely on fire. Look at Denver, downtown Denver. We probably have
certainly
a dozen multifamily products. Yeah. And, they're leasing them. Even
population growth.
Yes, that city has exploded. The city has almost reached the airport. And for those of us who remember when the airport opened, it was really far away.
I was at that airport 2 weekends ago.
Yep, and now 70 has just expanded to the airport. It's about a 40-minute run. So that whole area with Colorado Springs and everything else has just completely exploded in terms of development.
When they built that airport, I said, why are they taking away the old stable? This is stupid. Yeah, gee, what vision I had. Yeah.
No, people are going to start expanding east away from the airport. That's already happening.
Wow. Yeah, they'll be in Nebraska.
Exactly. But anyway, markets are going to be very interesting. I think the fact that the dollar's been trading off the way it has been is going to make for a very interesting year. Because think about it, running a short in dollars doesn't cost very much.
And I think this rise in, we're seeing in front of our eyes is the air leaking out of the bond bubble, whether it's here, whether it's in Europe with the German 10-year breaking out above this multi-year range. I don't know necessarily where the pace of it from here, but things are changing before our eyes in interest rates and currencies. And if there was going to be a major risk to this whole tranquil environment that is perceived to be, it's the rise in interest rates and certainly a big drawdown in the U.S. dollar. Commodity prices at multi-year highs, the CRB printing 200 yesterday and holding there today. I think things are changing, and there's still a lot of nonchalance in the face of that.
Well, of course. Markets sometimes just kind of trade around numbers for a while for no particular reason, and then you have an event which wakes everybody up and it moves, like the election. If you look at most charts for the bond market, there's this big discontinuity around November of a year ago. And what do you do? Now it's moved, and it moved again for a variety of reasons. China used to be the excuse, but I don't think we'll have that now. Could be a fairly boring inward-looking year in China.
Now, Chris, on your article, you mentioned there could be downward pressure on long-term bond yields as the U.S. Treasury concentrates future debt issuance on the short-term maturities.
Yeah, that's the schedule. And again, going back to our earlier conversation, right? You're the Fed. You see Treasury in the market with huge issuance. It's going to, I think, put a lot of pressure on short rates such that they may blow past the targets and keep going. Imagine that. But meanwhile, the Fed isn't going to sell anything outright, and they're not doing anything on the long end. They should be selling the futures, at least. You don't want to sell the cash positions, fine, but do something, because otherwise we flatten, just like Peter said. I totally agree with that. And it may happen quick. It could happen in weeks. Imagine that.
I still expect a creep higher in long rates.
It'll bounce up, but it could easily rally. You want to be careful because there's so little paper out there.
Upside.
Yeah. Well, if they reopen the old issues, which they can do, then you'll know that somebody is yelling in that building and saying, "Hey, you should be issuing longer dated paper." But the Fed was planning to take their runoff and invest in the short end stuff the Treasury is issuing, right? But their runoff may be so slow that they may not have that much net cash if they want to keep up with that 20 billion decline in the overall portfolio. So I think it's a funny situation. It goes to what Peter was saying. We could have a really nasty market environment this year because the Fed can't help, the banks can't help. They're not allowed to anymore, right? So the street has no strong hands here that can come in and push on a bad auction or push on the dollar if it gets messy. They would just have to intervene.
And quietly, go ahead, Ira.
And if they start, if they were to actually start, if Powell said, well, I want to sell off, then, go back to your first point, Chris, is that they're going to incur losses. And then they're going to say, hey, we have losses on our books from this year because we're actually taking some losses on the long end stuff that we bought. So they're kind of locked in that situation. And the situation on the front end has gotten so interesting that I actually called somebody at the CME and said, I think it's time for them to dust off the old T-bill contract and bring it back because it may become of a great useful purpose besides the euro dollar.
Well, no, but this is the thing. The Fed economists in Washington were bragging about the fact that they made money on QE. And they don't understand.
I know, but
it's
anybody's
stupid.
A printing press.
But to your point, though, Ira, what Powell has to do is get up and say, we're going to be selling some bits of the portfolio to help accommodate the Treasury's issuance and to rebalance because it's far too long. And they could do that in a variety of ways, but then he's got to look at them square in the eye and say, and by the way, this is going to reduce remittances for years. They have a little account. It's called a negative asset. They came up with this, right, where they put the losses. So the Congress capped the Fed's capital at $40 billion, okay? And they confiscated the surplus for highways. So this is the situation you have, and they don't want to be insolvent. If there's a big number in this contra account and they have $40 billion in equity, people can do the math, right? So that's the politics of this. It's very strange. You got to realize these are like, central bankers. They're very funny, and it's a big factor. So if Powell changes that, that's a big deal.
I think also a key factor is how much control are these central banks going to have over their external environment. I mean, I'm of the belief that markets are going to force their hands. I mean, I believe that inflation is cyclical as opposed to structural. Cyclical inflation pressures are going to force their hands, whether it's commodity prices or wages, supply chains. I read the article yesterday in the front page of the Wall Street Journal how it's almost impossible to find a truck to deliver your goods, and people are paying hand over fist to just try to find drivers. That I don't think it's necessarily fully in their hands. I mean, Powell is going to have to start watching the German 10-year yield every day. I mean, behind the scenes, obviously the liquidity flow is turning into more of a drip, and that all these central bankers have to look at each other, because what one does is going to really influence what the others do, both on the upside and downside. I mean, when you think about this rise in interest rates, as some of these banks start raising, it gives other central banks cover. So you're less inclined to keep rates low if other people are doing it on the upside, just as we saw the reverse. So peer pressure cut rates to nothing, and it's going to do the reverse on the upside. And I think that also feeds on itself. And I'm just amazed at people believing that this is somehow going to be a smooth process, and historically never is.
Oh, no, but it's even worse now because they took cash flow out of the system by forcing rates down. You know, forcing rates down is a debtor-friendly policy. It's meant to transfer value from savers to debtors. So now you have more volatility in the system because there's less cash flow. And people also have very little fat. There's not a lot of just embedded savings in the system from carry, because your assets don't throw off that much cash flow. You know, it's stunning when you look at like Bank of America, and the gross yield on their book is 4%. They're not making money. You know, the whole industry has got a negative risk-adjusted return because the return on assets is so low. In fact, I think the number for the industry now is 0.75% on earning assets across the board. It used to be over a point. And so the central banks, by constantly forcing rates down, they're taking carry out of the system, and it's not good. It's deflationary ultimately, you know. So, but I looked at that thing, Peter, and I totally agree on. I'm going to have a lot of fun watching this, especially for Resi. I was doing comments today for one of the regulators about whether or not they should allow different credit scores for underwriting loans. What do you guys think? Think that's a good idea to have more than one way of measuring something like that?
Makes sense.
Yeah, so I think this whole FICO, you know, from a private, you know, having my kids go through this stuff when they have to, I think it's ridiculous. It's truly ridiculous in the way that they measure it, and they hold everybody accountable to the single standard. I know it made the banks comfortable over time, and there was a need for it. But honestly, if I ran a bank, if I ran a small community bank, I would never do business like that. And I know they saddle with them, but that's not the way you do business.
Well, that's what I'm telling them, Ira. Like I said, the government shouldn't be in the business of picking one. You let the people who underwrite loans figure this out, and then the market's going to tell them whether they like it or not, because they'll price the pools accordingly. So I think we can figure this out real fast. Anyway.
Just as a final question, if we can go around to give your thoughts on where central bank policy, monetary policy, and government fiscal policy is going this year, 2018. Your thoughts, Chris?
Well, monetary policy, I think they're going to try and stay on the program as far as rate increases. But you get the 10-year, stock and keep moving Fed funds up. You have a flat curve, and I think they'll have to stop at that point. Fiscal side, I don't see any inclination to discipline in Washington. It's a train wreck. They're going to have to figure out how to raise some revenue. Otherwise, we're staring at pretty scary deficits. And I think eventually the credibility of the United States will suffer.
And Peter?
Well, I think the weakness in the dollar is beginning to reflect the worries of those debts and deficits, and that maybe we do have $1 trillion budget deficit again in 2019. Obviously, fiscal policy in terms of the tax cuts are in place, and everyone's got their fingers crossed that it actually improves economic growth as opposed to just improving earnings per share. We are seeing some wage growth, which is a good thing. But I think that's one thing that we've seen is that the assumption on Wall Street was that the tax cuts, all of it would flow to the bottom line, and we're seeing that not all of it will flow to the bottom line.
And the repatriation narrative is infantile. I cannot believe that people with PhDs in economics can sit there and go on and on about how cash is going to be brought back and invested in the United States. And
a lot of that
finance works.
Yeah, and a lot of the cash has been spoken for anyway with all the debt accumulation to buy back stock. So companies have already front-loaded the repatriation by taking on this debt.
Of course. But if you look at tax shelters, like you saw the hit that Goldman took because they're the great tax shelter shop. And, a lot of that stuff is not going to come to light. You think everybody's going to go to the IRS and turn themselves in? The case with Dow last year that the Supreme Court declined to hear was a big deal. Donald Trump has the same tax lawyers as Dow. Trust me, that the IRS now, any corporate they go to that did these sham partnerships as tax shelters, they basically just have to write a check. They have no appeal. And there's trillions of dollars at stake here. And trust me, these corporates are not going to come forward and say, "Oh, wait, I did this wrong." Nope.
Well, I continue to believe that the other side of the easing mountain is upon us, and that creates the biggest risk for markets and the economy. People say, okay, well, we're not going to have a bear market until the economy goes into recession, and I argue that it's going to be the rise in interest rates that leads to a decline in stocks that then leads to the recession. And $1 trillion of liquidity coming out from just the Fed and the ECB alone is going to be a big deal as we get deeper into the year. I mean, that's what we have to look forward to over the next 2 years. The Fed taking out $1 trillion alone the next 2 years after beginning that in last year. The ECB ending QE, and that's a $600 billion reduction in their run rate in 2018. And then the elimination of negative interest rates. So that's what we have to look forward to in the next 2 years in terms of interest rates. And I don't see risk assets just whistling past that.
Oh, no. Look, everything is compressed. The whole curve's going to expand. Ira?
No, it's everything that we're talking about. And then you throw in the infrastructure spending package that Trump is going to get through. I mean, he's not only selling the world today. It's interesting to watch how he totally hijacked Davos because they couldn't lick his boots fast enough, and it's disruptive. But so you got all this more debt coming on. You've got really discussions about can the United States, of course, finance this debt. We're going to find out as interest rates are going higher. We know the answer to it, but the rest of the world's going to have to find out. You have the ECB who took the Bernanke model and did everything they could to explode it in the amount that he could buy. And he's still, Peter, I know he's going to end in September, but he's going to have a massive amount of assets on that balance sheet of the ECB, and with the Germans breathing down the neck, it's really there is nothing good going on there. There's nothing good, and it's going to come back to haunt. And then we have Joe from China, and he's reminding us about Minsky. The Chinese are reminding us about Minsky, so we know we're in a very difficult situation, and the world is just they're sleeping through it because you know what? You wake up in the morning and you see your stock portfolio is doing a whole lot better. You go, what's the difference? We're all good here, and they carry on. So, but I think this year, I think it's going to be this year. I don't think it's waiting for 2019. Some of these issues that people have chosen to what's the word? To pretend don't exist, and it is. It's all borrowed. We always know. I think the three of us would agree that all crises come up from the debt market. Credit and debt markets determine everything, and we're there. And we're there. It's just going to be what's going to be the actual spark that sets it off. I'm not sure. I agree. I do agree with Peter. It's going to be central bank oriented, and it's going to become as they change the direction. And I think, Chris, you'd agree with that too. It's just the machinations of how they do it. And Jerome Powell is going to be an interesting guy to be sitting there to see how he reacts to it.
Yeah. Well,
I think a very important question is where is the out of the money put strike price right now on the Fed? What level, what % decline tells Jerome Powell I need to stop my tightening or reverse it? Because I think that's going to be an important question. What's his tolerance level if these asset markets reverse themselves? If the stock market,
but that's an important question you're asking, because the tolerance level heretofore was very low. In other words, they wouldn't tolerate any market upset.
Right. Does Powell have more tolerance?
Maybe a little different. Yeah, I think he does.
I agree.
15% sell-off in the equity market? I don't know.
That's the question, Ira.
Yeah.
Do they have a little red button?
You get a 20% correction, you're just back to where you were last year.
Well, Powell has an easy button on his desk. The question is, does he push it?
Right.
Yep, I think that's absolutely right.
I mean, as we speak, interest rates here are breaking out today. 10 years up to 267 now. 2-year approaching 213.
And the Europeans are just, they're holding there. They're not the ones. They're not the catalyst. Other days are the catalyst. I know, I'm watching this. It's interesting to see it.
Yeah, the dollar rallied for about a couple of hours after Trump tried to defend it, then went straight back down again.
You know what? And the one, forget the Swiss. We didn't even get into our discussion, Chris, with the Swiss, because they get the Alchemy Award of the last millennium. The game that they've played here and pulled off is unbelievable to me. It tells you about the state of the world. But
Peter's right. They could take a loss on all that corporate exposure they have. That'll be a lot of fun.
Well, they say, you know what, Richard, they finally admitted now that they're going to be the cryptocurrency capital of the world. They want to carve out that niche. They have been the cryptocurrency capital of the world.
Already.
Frank is nothing but a cryptocurrency.
Yeah, exactly.
But I think that's absolutely right. And it's interesting, Peter, that it was the yen that turned when Kuroda was speaking at Davos today. The yen turned very hard.
Yep, it did.
Yen went down. Yeah.
Yeah. He said he's getting more comfortable. Inflation's going to their target.
Yeah, and I think the Japanese are waking up that the Trump administration is none too happy with the yen being so relatively weak. That and Draghi and Kuroda can pretend all they want because what was that comment yesterday from I know they all went back to the damn G27 meeting in Washington, which I kind of thought that they would, but he said, well, monetary policy that has a negative effect on currencies, that's just an effect. That's not a targeted currency, right? And that's why every central bank, when they release their statement about their interest rate intention, always cites the level of the currency. Everybody but the United States, that is. But everybody talks about the level of the currency. The Australians, the Australian dollar is this. The Canadians, everybody discusses the level of their currency as being one variable in determining how they're going to set interest rates.
Well, interesting times and great insight on the credit markets, financial markets, and the economy. Thank you very much, gentlemen, for being on the podcast program show. Great discussion.
This is great. I'd love to do this again. This is great.
Just as
thank you, guys.
A final word for our interested readers, how can they find more information about your work, Chris?
Just go to my website, rcwhalen.com. It's the same handle on Twitter. And the Institutional Risk Analyst, of course, which is the free newsletter.
Great. And Peter?
Bookreport.com, BOOCK report.com, and look at the asset management business, bleakly.com.
Great. And finally, Ira?
Yeah, you can find my blog, iraharris.com, and sign up for Notes from Underground, which is also free whenever I write, which is sometimes 4 times a week, sometimes 1 time a week, but just, and you get a lot of the same discussion, and these are great. And listen to these FRA podcasts because I think they're very, very informative.
Great. Thank you, guys. And maybe we can do it again also all together. Great discussion.
Great.
That's good. Thank you.
Guys.
The FRA Roundtable Insight Show is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.